One of the things about investing in real estate is that there are all sorts of ways that an investor can get tripped up. And one of our goals in the real estate executive education program here at Wharton is to have people discover those potential pitfalls in the classroom rather than when they have real money invested in a deal. People investing in real estate often are looking for higher yield or higher return than they can get in other investments. That's why real estate has often been considered an alternative. But one thing people have to keep in mind is that a higher yield or higher return almost always has to come with additional risk. And the trick in real estate is figuring out where that risk is coming from. If someone's promising you outsized returns, there's an outsized risk somewhere in there. One of the keys to being a successful real estate investor is not just identifying the risks of your investment, but figuring out whether you can manage them. Truth be told, real estate is not an efficient industry. It's an industry where you can still find bargains and get good deals. It is an industry where there's a lot of execution that goes along with the investment. And so to find a partner who has the ability to execute well and find those good deals, you can outperform. But higher returns doesn't necessarily mean that's a partner that's going to generate outperformance. You need to figure out whether they are managing the risks. Real estate is a boom-bust industry. And what we always see is during the booms, investors get lured into complacency by the fact that things have just been going well for a while. In our program, we will teach you how to recognize the signs of a boom that has been going on for a while and how to adjust your investment strategy to be more defensive in recognition that there will eventually be a crash. Real estate is a capital-intensive industry. And investors need to remember that when they're investing in real estate, they're not just investing in the properties, they are investing in the financing that's being used to purchase or acquire those properties. And people tend to forget that. They look at the real estate and they don't look at the capital structure. Probably the biggest example of this was General Growth Properties. It's a huge publicly traded mall company, $35 billion worth by the mid-2000s. It had terrific malls, at the top, the nicest malls in the country. It had mixed-use development going on. It had a whole development pipeline, had terrific real estate. But it financed it with a lot of debt that was short-term. And once the capital markets closed, it couldn't refinance and it went bankrupt, the largest real estate bankruptcy ever. You have to look at capital structure. I don't mean to pick on General Growth Properties, because its story, the one of great real estate being brought down by its capital structure, is a common refrain throughout the history of real estate. And so in our program, in our real estate executive education program, we are going to look at not just the property, not just the real estate, but also how it's financed and the risks of those together to help you understand how to evaluate real estate investments holistically rather than just at the top line property.